Okay, let's unpack this. We're doing a deep dive today into a recent briefing you shared,
Yeah,
focusing specifically on the mortgage market.
that's right.
We're pulling out the key insights, the data. It's all current as of today, June 7th, 2025.
Exactly. And, jumping straight into the main headline from this briefing, mortgage rates. They're actually unchanged today.
Unchanged.
I
Okay. What are the specific numbers the briefing mentions?
Yeah, it notes the 30-year fixed is holding steady at 6.73%,
6.73. Okay.
and the 15-year fixed is sitting at 5.95%.
Got it. Now, the briefing also gives some context for why things are sort of flat today. It mentions yesterday's strong jobs report.
Exactly. That report, well, it definitely gave the stock market a lift, as you'd probably expect,
Sure.
but it also had a pretty noticeable effect on the bond market.
Right, and this is where it gets interesting for mortgages. The briefing points out that the strong jobs numbers made bond yields climb. Specifically, the 10-year Treasury yield went up over 2.5%. So maybe explain that connection. Why does a jump in the 10-year Treasury yield matter if I'm looking at mortgage rates?
That's a really key link. Think of it like this. Mortgage rates tend to follow the yields on bonds like the 10-year Treasury pretty closely.
Okay.
So when those bond yields go up, it makes bonds look, more attractive compared to mortgage-backed securities.
Ah, right. Competition for investment.
Exactly. So to stay competitive, mortgage rates usually have to rise too. So this increase in bond yields, the briefing says it may lead to higher mortgage rates next week.
Makes sense. So even though rates are flat today, that underlying market stuff suggests maybe some upward pressure coming soon.
Potentially, yeah.
Given that things are kind of volatile, like you mentioned, how does the briefing frame today's unchanged rates? Is it good, bad?
It actually calls holding steady today good news.
Good news, okay.
Yeah, just because the environment is, as the briefing puts it, pretty volatile. So even one day of stability is seen as, a positive sign in that context.
Okay, so wrapping up the sort of immediate picture from this briefing.
Yeah.
Steady for now, but maybe watch out next week because of those bond yields.
That's the short-term view, yeah.
Now, zoom out a bit. Connect this to the bigger picture for 2025 that's laid out in the analysis. What's the expectation for rates through the rest of the year?
Looking further out, the briefing expects rates to stay mostly steady throughout 2025.
Mostly steady.
Uh-huh.
Does that mean we should be hoping for rates to drop significantly? Any chance they'll, plummet?
The briefing is quite specific on that. It says no significant drops are really anticipated.
Mhm.
And it uses that exact word, rates are unlikely to plummet this year.
Okay, so a holding pattern seems more likely than a big dive. Got it. Now, this briefing also links the rate situation to the housing market itself. What's the takeaway on home prices right now?
Yeah, it notes that home price growth, it's definitely slowing down.
Slowing down.
And it even includes some predictions that house values might actually decrease this year.
Wow, decrease. That feels like a pretty big shift, especially when you think back to the crazy price spikes during the peak COVID period. Sounds like those days are definitely over based on this.
Oh, absolutely. Prices are certainly not shooting up like they were then. And this actually leads the briefing to make an assessment about whether it's a good time to buy now, comparing it to that recent past.
Okay, so how does it describe the current market for potential buyers?
It uses the phrase, a relatively good time to buy.
Relatively good.
Yeah, but, and this is important, it specifically frames that comparison against those pandemic peak prices.
Okay. So not cheap, but better than the absolute peak.
Exactly. It's all relative.
That's a key distinction. And based on all this, the rate outlook, the price situation, what's the core advice the briefing gives?
Well, the main recommendation really is not to base your buying decision purely on trying to time the interest rate.
Right. So don't obsess over whether rates might tick up or down next week or next month.
Precisely. The advice is pretty clear. The best time to buy is really when it makes sense for your personal financial situation, your goals, rather than trying to, game the market just based on where you think rates might go.
That sounds like solid advice, though maybe tough to follow when rates feel like such a huge factor. So, okay, thinking about that advice, focus on your own finances, don't try to time the rate market, and considering what this briefing says about a slowing housing market, maybe even falling prices, what other factors, beyond just the interest rate, become really important for you to weigh up in this kind of environment? Definitely something to think about.